Most of the videos on my channel deal with technical topics in the field of water resources engineering, but every once in a while I'll find a topic that makes me curious. And one of the things I've noticed on social media is that there's this proposal to make mortgage payments half principal and half interest as opposed to using the normal amortization. I hear a lot of people say that mortgages are front loaded with interest, or that the bankers will make you pay all the interest up front. But is that the result of greedy bankers and the system working against you? Or is it just a function of the mathematics of how a mortgage works? So let's look at that in a little bit more detail. So for our example, I took a loan amount of $500,000, interest rate of 6%. That's a pretty simple interest rate to work with because for simplicity, we'll just assume 0.5% per month. 30-year mortgage, monthly payment's going to be about $3,000. So if we look at a normal mortgage, you can see, yes, you do pay quite a bit of interest up front, and most of your payment is going towards interest, but also you can see that with each subsequent payment, that the amount of interest that you pay is continuing to go down. The principal is just going to be just the inverse of the interest. So you're not paying a whole lot in principal early on, but again, with each subsequent payment, you do pay, more of your payment is going towards principal. Under this half and half proposal, throughout the entire life of the loan, you're going to be paying the same amount in interest and principal. So if we look at that in a little bit more detail, you can see in the first month that the amount of interest you pay, again, you're paying $500,000, you have a $500,000 mortgage, 0.5% in the first month. That works out to be $2,500 in interest that you pay, which leaves you with $498 roughly that is going to go towards principal. So not a whole lot went to principal, but some did. So in month 2, you have a smaller principal balance. So when you apply that 0.5% to a smaller principal balance, it means that you're going to be paying less in interest. In this case, it's about $2.50 less in interest, but that's $2.50 more on principal. Under this proposal where the interest and principal are equal, you pay the same amount no matter if you're in month 1 or month 360. So under this half and half approach, you do have more equity in the first year. You gain about $12,000 more in equity if you pay the same amount in interest and principal. So I want to look at the interest rate in a little bit more detail under this half and half approach. So even though you go and you figure out what your payment will be, similar to the way that you figure out a traditional mortgage, you'd have to do that based on today's interest rate, which I just said would be 6%. You can see that early on, you're not paying 6%. You're paying less than 6%. So you start out paying probably about 3.5%, 4%. You don't actually get to 6% interest until about year 12 or 13. The other thing to point out is that as you start getting towards the end of the loan, remember that your principal balance is continuing to go down, but you pay the same amount in interest, which means that compared to your principal amount, that this interest rate is getting very high. You can see that it's jumping all the way from about 20% all the way up to 80% in these final years of the mortgage. So you can see that they're jumping very high and they're going through the roof. Under this half and half approach, you do pay the mortgage off 2 years earlier and you save about $80,000 in interest. So under the half and half approach, you do pay about $500,000 in interest. Under the traditional mortgage, you pay about $580,000 in interest. One other thing I want to point out, though, is that you do need to have individuals or investors putting their money up for these types of mortgages. So if you remember that, you don't actually get to what would be today's interest rate until about 12 or 13 years down the road. So that would have to be attractive to an investor. You'd have to convince them that you're not going to make today's interest rate until 12 or 13 years down the road. And at that point, then you'll be making interest rate that's actually higher than today's interest rate. One other thing that you're probably thinking is that, well, what would happen if you paid the house off early? What happens if you sell the house? Or what happens if you refinance? So things like prepayment penalties, they're much less common than what they used to be. But to make this attractive to investors, would something like that need to come back? So I'm curious to hear about your comments. I do appreciate you watching this video, and if you found it helpful, go ahead and give it a like. Thanks.